This is the format of our consolidated financial statement. So on the face of the consolidated statement of profit and loss and other comprehensive income, you can see that basically for every items, the sales up to the total comprehensive income, we simply add together everything of the parent and everything of the subsidiary. So that's why this sales is actually 100% of the parent's sales together with 100% of the subsidiary's sales. The same for the cost of sales, etc. So everything, we just add 100% of the parent and 100% of the subsidiaries together. So we add them together. Of course, we just add them together if there's no intra-group transactions and no other consolidation adjustment. If there's no intra-group transactions affecting the profit and loss accounts, then we simply add 100% of the parent and 100% of the subsidiaries together. We understand that basically some of the subsidiaries may not be 100%. If that is the case, we have to allocate part of the profit to the non-controlling interest. Say for example, this profit after tax is 4,500. If there exists any subsidiary which is not 100% subsidiary, then part of this profit of the subsidiary should be shared to NCI, should be shared to non-controlling interest. Therefore, from this 4,500, we have to determine how much of the profits should be attributable to the non-controlling interest and how much of the profit should be attributable to the owner of the parent. So altogether, it must be 4,500 because this is profit after tax. So part of the profit of the subsidiary, if there exists subsidiary which is not 100% subsidiary, we have to share to profit to NCI. So today, we shall try to calculate how much is the profit attributable to the non-controlling interest. Usually, we'll calculate this profit to the non-controlling interest, then the rest will be the profit to the owner of the parent. The same for the total comprehensive income. This is the total. If there exists any non-wholly owned subsidiary, then you have to share part of this total comprehensive income to non-controlling interest. So that's why we should know how much of the total comprehensive income is attributable to the non-controlling interest. So if 1,200 is attributable to the non-controlling interest, then the rest will be the total comprehensive income attributable to the owner of the parent. So total is 6,000. This is our consolidated statement of profit and loss and other comprehensive income. Also, we prepare our consolidated statement of financial position. Consolidated statement of financial position. Just like the consolidated statement of profit and loss, income, expense, we add everything together. So actually assets and liabilities, we also add together. So these other assets include 100% of the other assets of the parent and 100% of the other assets of the subsidiary. And for this liability, the non-current liability, current liability, it is 100% of the parent's liability together with 100% of the subsidiary's liability. Of course, on consolidation, we may have created a goodwill. So remember, if we pay more than what we get, there will be a goodwill. Goodwill is an asset, so therefore goodwill will be stated under non-current asset. This applies to income, expense, assets, and liability. We add 100% of the parent and 100% of the subsidiaries together. The fifth element is equity. Equity. For equity, we don't simply add them together. We will insert one line for the non-controlling interest. This is the equity to the non-controlling interest. We will add this non-controlling interest just before we total up for the total equity. If we insert this non-controlling interest here, that means anything above the non-controlling interest actually does not belong to the non-controlling interest. There are only two types of shareholders, non-controlling interest and the controlling interest. Controlling interest means the parent, right? Shareholders of the parent. So that's why this share capital actually is the share capital for the parent. Retained earning is the retained earning for the parent. There may be some more items like general reserve, other reserve, revaluation reserve, translation reserve, etc. Everything belongs to the parent. So this 451,220 is the equity for the controlling interest, and this 82,480 is the equity for the non-controlling interest, and this will be the total equity. So assets, liability, income, expense, we simply add 100% of the parent and 100% of the subsidiary, but for equity, we cannot simply add them together. Now we got the consolidation adjustments. So consolidation adjustments, as I've said before, no matter how simple the consolidation is, at least there will be one consolidation adjustments, because the investment in subsidiary will be eliminated against the equity of the subsidiary at the day of acquisition. So that's why this is the entry at the day of acquisition, or sometimes we call it pre-acquisition entry. So this is the entry that we must make at the day of acquisition. So we'll eliminate the investment in subsidiary. We credit away the investment in subsidiary. We will revalue the subsidiary's assets and liability at fair value, because business combination financial reporting standard number 3 require us to value the assets and liability of the acquiree at fair value at the day of acquisition. So you may have to revalue it. We have to eliminate the share capital and any pre-acquisition reserve at the day of acquisition, because the investment in subsidiary is actually paid for this equity at the day of acquisition. If they cannot balance, there may be a goodwill. And of course, if there is a subsidiary which is not wholly owned, there will be a non-controlling interest. So after we consider this non-controlling interest, balancing figure will be goodwill. There may be intra-group transaction. So whenever the parent sells something to the subsidiary sells something to the parent, one subsidiary sells something to another subsidiary, this will be an intra-group transaction. All these intra-group transactions, all these intra-group balances should be eliminated. And if there exists any non-controlling interest, remember that we must share the profit to non-controlling interest. So this is the worksheet again. So simple one. So we got everything of the parent, everything of the subsidiary. So no matter how simple it is, we must eliminate the investment in subsidiary against the equity of the subsidiary at the day of acquisition. So we'll credit away investment in subsidiary, we debit away the share capital, we debit away retained earnings, we debit away any other reserve, revaluation reserve, translation reserve, etc. at the day of acquisition. If there exists any non-controlling interest, you have to credit non-controlling interest. Non-controlling interests are shareholders, so they are equity. Equity, normal balance is a credit. Credit. If they cannot balance, there may be a balancing figure. The balancing figure is what we call goodwill. So therefore, we will prepare this pre-acquisition entry like this. So as I've said before, we need to credit investment in subsidiary, and we debit the equity of the subsidiary at the day of acquisition. So we debit share capital, we debit retained earnings, and we debit other equity at the day of acquisition. There may be a fair value adjustments, because we have to revalue everything of the subsidiary at the day of acquisitions to fair value. Because of this fair value adjustments, there may be a deferred tax implication. If the fair value of the assets go up, you have to credit deferred tax liability. You have to credit non-controlling interest if there exists any non-controlling interest. If all this cannot balance, the balancing figure is goodwill. Goodwill. As we have been discussed during the business combination, non-controlling interest may be carried at fair value. If non-controlling interest is carried at fair value, this goodwill is the total goodwill. Full goodwill include the goodwill for the parent and goodwill for NCI. If non-controlling interest is simply stated as a proportion of the fair value of the net assets of the acquiree, then this goodwill is the goodwill for the parent only. Partial goodwill method, right? Because NCI is only stated as a proportion of the fair value of the net asset, there will be no goodwill of the NCI presented in your consolidated financial statements, and therefore this goodwill is only the goodwill for the parent.